Did you know that assets held by money market funds surpassed $6 trillion for the first time in January 2024 as more and more people shy from saving their cash in banks? In this video, you'll learn exactly why investors are decreasingly saving their cash in banks and why they are embracing money market funds. We want you to be financially free and guide you on different topics through my channel. Please do not forget to subscribe. We'll also tell you what you need to consider before getting into these investments and give some examples of the top money market funds for 2024. Let's get started. First, let's talk about the changing face of banking. For the longest time, going to the bank was a routine task. You'd deposit your money, maybe take out a loan, and that was that. Lately, however, banks have been acting more like characters in soap operas than pillars of stability. Since the COVID-19 pandemic, things have been quite different, with even some of the biggest banks becoming very shaky. In 2023 in particular, things reached a boiling point. First Republic Bank saw a massive withdrawal of over $100 billion. Other big names like Silicon Valley Bank and Bank of America were feeling the heat too. So, what to do? Enter money market funds, the unsung heroes of finance. These funds offer a safe place to stash your cash away from the drama of traditional banks. And the best part, they come with high interest rates, making them a tempting alternative to savings accounts. But what exactly are money market funds and how do they work? Think of them as a special type of investment that focuses on short-term, low-risk assets like government bonds and commercial paper. They aim to keep your money safe while still earning you a bit of profit. Unlike traditional banks, which may use your deposits for risky investments, money market funds stick to the basics, offering stability in uncertain times. Essentially, money market funds pool together money from investors like you and me. They then use this collective pool to buy a variety of safe assets, collecting interest along the way. Let's take a look at the history of money market funds from inception to today. Money market funds have a fascinating backstory that dates back to the 1970s. Back then, banking regulations were quite strict and banks weren't allowed to pay interest on demand deposits. This meant that if you parked your money in a bank, it wouldn't earn anything in return. Understandably, this didn't sit well with investors who wanted their money to work harder for them. Enter Bruce R. Bent and Henry B. R. Brown, the financial masterminds behind the first money market fund, the Reserve Fund, introduced in 1971. Their idea was simple yet revolutionary. Create a fund that invests in short-term, high-quality debt like treasury bills and commercial paper. The interest earned from these investments would then be passed on to the investors. This concept was groundbreaking. Suddenly, investors had a way to earn returns on their cash reserves without sacrificing liquidity or safety. Money market funds offered higher interest rates than traditional savings accounts and even came with the added perk of check-writing privileges. Throughout the 1980s and 90s, money market funds experienced rapid growth and popularity. Investors flocked to these funds like bees to honey, drawn by their stability and modest returns. However, like any success story, there were bumps along the way. The 2008 financial crisis shook the financial world to its core, and money market funds were not immune. The Reserve Primary Fund, one of the oldest and largest money market funds, famously broke the buck, meaning its net asset value fell below $1 per share. This event sent shockwaves through the industry and prompted regulators to tighten oversight of money market funds. Today, money market funds continue to play a vital role in the financial ecosystem. They provide individuals, businesses, and governments with a safe and efficient way to manage their short-term cash needs. From their humble beginnings in the 1970s to their current status as a staple investment option, money market funds have proven to be a resilient and indispensable tool for investors worldwide. Moving ahead, let's look at the different types of money market funds. Money market funds come in various flavors, each catering to different investor preferences and needs. Number 1. Treasury money market funds. These funds primarily invest in U.S. Treasury bills and securities. They're considered the most conservative option, backed by the full faith and credit of the U.S. government. If you're looking for stability and safety, Treasury money market funds are the way to go. Number 2. Prime money market funds. Prime funds cast a wider net, investing in a range of high-quality short-term instruments, including commercial paper and repurchase agreements. While they offer slightly higher yields than Treasury funds, they also come with slightly more risk. Prime funds are suitable for investors seeking a balance between safety and returns. Number 3, municipal money market funds. These funds focus on short-term debt issued by municipalities and their agencies. While not as widely known as treasury or prime funds, municipal funds offer tax benefits for investors subject to federal and sometimes state income tax. They're a niche option, but can be advantageous for certain investors seeking tax efficiency. Number 4, tax-exempt money market funds. Similar to municipal funds, tax-exempt funds invest in securities exempt from federal income tax. They're ideal for investors looking to minimize their tax liability while still earning a competitive return. Tax-exempt funds may not offer the highest yields, but the tax advantages can outweigh this downside for many investors. Now, what are the advantages of money market funds? Number 1, safety. One of the primary draws of money market funds is their focus on capital preservation. By investing in high-quality short-term securities, these funds aim to maintain a stable net asset value, NAV, and protect investors' principal. For risk-averse investors or those with short-term cash needs, the safety of money market funds provides peace of mind. Number 2, liquidity. Money market funds offer unparalleled liquidity, allowing investors to access their funds quickly and easily. Unlike other investments that may have lock-up periods or transactional complexities, money market funds allow for seamless withdrawals, making them ideal for emergency savings or short-term financial goals. Number 3, yield. While money market funds may not offer sky-high returns, they typically provide higher yields than traditional savings accounts or certificates of deposit, CDs. For investors seeking a modest return on their cash reserves without taking on significant risk, money market funds offer a compelling balance of safety and yield. Number 4, diversification. Money market funds provide a simple yet effective way to diversify a portfolio. By investing in a range of short-term securities across different issuers and sectors, these funds help spread risk and minimize exposure to any single asset or market segment. Diversification is a cornerstone of sound investment strategy, and money market funds offer an easy way to achieve it. Number 5, convenience. Investing in money market funds is straightforward and accessible to investors of all experience levels. With low minimum investment requirements and user-friendly platforms offered by fund providers, anyone can start investing in money market funds with ease. Additionally, the ability to write checks directly from some money market fund accounts adds an extra layer of convenience for investors. While money market funds offer many benefits, investors need to understand the potential considerations and risks associated with these investments. Firstly, there's interest rate risk. Money market funds are sensitive to changes in interest rates. When rates rise, yields on new investments increase, but the value of existing securities may decrease. Conversely, falling rates may impact yields and affect the fund's returns. Secondly, there's credit risk. Although these funds invest in high-quality short-term securities, there's still a risk of default by the issuers. While rare, a default or downgrade could lead to losses or a decline in the fund's net asset value. Thirdly, liquidity risk is a consideration. While money market funds aim for liquidity by investing in short-term securities, market conditions or investor redemptions could disrupt this. During market stress or heightened withdrawal demands, meeting redemption requests promptly may be challenging. Moreover, regulatory changes pose a risk. Money market funds are subject to regulatory oversight, and alterations in regulations could impact fund operations or investor returns. Post-2008 financial crisis reforms aim to enhance stability, but also introduce new requirements for fund managers. Lastly, there are yield fluctuations. Although these funds typically offer stable returns, yields may vary due to market conditions, interest rates, and other factors. Investors should be prepared for potential fluctuations in income distributions. Now, how do money market funds fit into your financial plan? To start, they serve as an ideal repository for your emergency fund. With their high liquidity, money market funds ensure your funds are readily accessible for unexpected expenses or financial emergencies. Additionally, suppose you're saving for short-term goals such as a vacation or home renovation or planning for upcoming tuition fees. In that case, money market funds offer a safe and stable place to park your cash while still earning a modest return. Moreover, these funds can serve as a cash management tool for both individuals and businesses. They provide a convenient way to temporarily park excess cash, earning interest until needed for other purposes. Incorporating money market funds into your investment portfolio also aids diversification, reducing overall risk. Balancing higher risk investments with the stability of money market funds creates a more resilient portfolio. Furthermore, they act as a stabilizing force during market volatility, cushioning your portfolio against downturns with their stable net asset value and conservative approach. Let's now quickly go over the top money market funds. In 2024 first, we have the Fidelity Money Market Funds, which requires a minimum investment of just $1. It boasts an expense ratio of 0.43% and a 7-day yield of 4.56%. Next up is the Schwab Value Advantage Money Fund Investor, which is similarly accessible with a minimum investment of $1. It has a lower expense ratio of 0.34% and a slightly higher 7-day yield of 4.68%. The T. Rowe Price U.S. Treasury Money Fund demands a minimum investment of $2,500. This fund has a competitive expense ratio of 0.30% and a 7-day yield of 4.54%. For the J.P. Morgan Liquid Assets Money Market Fund, investors need a minimum of $1,000 to get started. It has an expense ratio of 0.58% and a 7-day yield of 4.57%. The Vanguard Federal Money Market Fund sets its minimum investment at $3,000. With an impressively low expense ratio of 0.11%, it offers a 7-day yield of 4.77%. Likewise, the T. Rowe Price Government Money Fund also requires a minimum investment of $2,500. It maintains an expense ratio of 0.31% and a 7-day yield of 4.50%. Finally, we have the BlackRock Wealth Liquid Environmentally Aware Fund Investor, asking for a minimum investment of $1,000. Its expense ratio stands at 0.49% with a 7-day yield of 4.49%. Are you ready to invest in money market funds? Let us know in the comments. If you enjoyed the video, you'd love to hear our other ones. So subscribe and remember to like and share this video widely. This helps me reach better and motivates me to make more such videos.